Today, I'll be discussing Pakistan's current economic outlook and the probable ways to navigate the prevailing economic uncertainty. The primary objective, that's why we chose this topic, is to equip the investors of at least the key economic outlook, which should in turn help you guys make the financial plans in these uncertain economic times. I'll try to keep this presentation easy in order for you to absorb the information while also doing justice with this topic. सबसे पहले स्टार्ट करते हैं मोटी बात से द करंट इकोनॉमिक आउटलुक इज अ क्लासिक टेक्स्ट बुक केस ऑफ stagflation. Now for you guys to understand what the stagflation actually is, it implies a growth deceleration, high unemployment accompanied by high inflation. This inflection point that we have reached by now is a result of years long of economic policy neglect and the lack of much needed direction setting. Now, with this backdrop, while such a situation ideally demands an emergency action for a possible rehabilitation, instead, what we did, we remained desensitized to the point where the IMF program appears to be stalled. And guess what makes things worst ever? Yes, right. It is the global geopolitical and the economic environment which has been subject to a series of back-to-back events, making navigation in the economic uncertainty an increasingly daunting task. Now let's explore this point, the last point, in a greater details in the following slide before jumping to Pakistan. Latterly, the global financial markets are marked by the pandemic, Russian-Ukraine conflict, Fed tightening, and the banking crisis. All of these events continue to blur the global economic outlook. Particularly, the occurrence of event in such a short period of time has been unprecedented this time around. As a result, what happened? The inflation reached a multi-decade high in many economies due to the pent-up demand post-COVID. The lingering supply chain disruptions due to the geopolitical issues and the resulted from the commodity price spikes. So what happened? In this process, the unexpected failures of major regional banks in the Western world, US, the Silicon Valley Bank, the most renowned in Europe, the Credit Suisse Bank, and the turmoil started from the Bank of England, that is in UK. All these banking failures have roiled the financial markets at large, with banks, depositors, and the investors reevaluating the safety of their holdings. Furthermore, if we look the sovereign debt defaults of Sri Lanka and Ghana, they further dampened the investment sentiments. Furthermore, like there have been a years-long globalization drive. However, that globalization drive got marred by the geopolitical fault lines led to further polarization across the globe. A classic example of this event is OPEC Plus output cut of 1.1 million barrels per day post Iran-Saudi reconciliation. Now, with this recent increase in the financial market volatility, the uncertainty is so high that the balance of risk has shifted firmly to the downside, leading to recessionary fears. Now, let's review the international growth forecast. Net, there remain a consensus across major forecasts on a slower global economic growth in the year 2023, amid heightened fear of a recession in the US. As per the latest IMF estimates, the baseline forecast for growth falls from 3.4% in 2022 to just 2.8% in 2023. The effect is more intense in the advanced economies. And in case of further banking crisis, these effects can worsen further, and the growth will fall for the advanced economy. The growth will fall further from 1%. As you can see, these orange bars, in the stress case for the advanced economies, the chart in the middle, the growth will fall further below to 1% in the stress case. So now, given this global economic environment, before we move on to the Pakistan, I would like to have your special attention. In our humble view, the Fed rates appear to have been peaking out while inflation has been gradually cooling off in that scenario. Now, for the global investors, investment in a long-term US Treasury bonds present a highly attractive investment proposition. As long as the Fed or the US Treasury defaults, or in that case, the recession fears will loom. So, with the disclaimer that we do not have the grip on that subject, but as of now, we believe that investment in a longer term US Treasury would be a better option for global investors. Secondly, gold will continue to serve as a safe haven for global investors and remain a preferred investment option in this environment. Now let's move on to Pakistan. Now, if you can look at the graph on your left-hand side, which shows the GDP growth trend, and on the right-hand side, we have a graph that shows the forecast from the various international institutions regarding the Pakistan GDP growth forecast. Now, on the left-hand side, the pattern of economic growth in Pakistan, there are 2 points that to be noted here. Number one, the pattern lacks consistency. If you see, there is like from 63 till now, there's a constant boom bust cycle. Secondly, the growth is clearly decelerating over the years. Now, throughout our history, this inconsistent trend of economic growth led vicious cycle of boom and bust. In fact, the history tells us that we can't really afford higher level of economic growth for a longer period of time without compromising our balance of payments. The balance of payment, it's the topic which we will be covering in just a while. Now, it is important to note here that during the previous years of crisis, in 1971, post-war, and in 1998-9, when we took the atomic explosions, Pakistan managed to remain a relatively higher growth rate while inflation remained in a single digit. However, in the current economic situation, there's a stark contrast with those events in the past, as there are dark clouds over the short-term horizon depicting stagflation, as I've already alluded to earlier, implying a highly challenging macroeconomic landscape. Now, if we look at the growth forecast for FY23, the situation in itself is very alarming. There's a potentially across the board fall in value added by all three major segments of the economy this time around. That is the agriculture sector, the industrial sector, and the services sector. Already, there has been probably the sharpest downward revision in the economic growth rate in our history. We started the year with from the budgeted estimates of 5%, and then post-flood, the estimate was revised downward to 2 to 3%. Then the international agencies, they have downgraded a growth forecast to zero point 0.4 from 0.4% to 0.6% in FY23. However, in our view, these assumptions are still fairly optimistic. We would like to settle below -1% for this year. However, going forward, the expected growth rate hovers around 2% to 3.5%, at least thanks to the low base effect and the pickup in the agricultural output post the floods, 2022 floods. By now, as we have presented such a gloomy picture, you might be thinking that there is no light at the end of tunnel, but perhaps there is one. Provided that we control the prevalent situation wisely, we can beat these expectations. There is no denying that if we choose the right path, which I'll shed the light on later in this discussion, we can come out of this crisis given our vibrancy and resilience despite facing all the major headwinds recently. Now, moving on to the following slides, will present a more deeper analysis of our economy, just to give you a sense of the acute situation which we have put ourselves into. To start off, the industrial growth pattern is right in front of us, represented by the year-on-year change in the large-scale manufacturing index, that is the LSM. The LSM index went down 12% year-on-year in Feb 23. On the cumulative basis, for 8 months FY23, the LSM is down 6%, drop and the bump in growth earlier in this 2020 till 2021, which is a pre and post pandemic levels where the demand was suppressed and later it was a pent up demand period. This slide shows us grow the sales data for the key industry across major industries, which sort of further validates the LSM data. Cement, fertilizer, autos, petroleum, the sales are down on a year-on-year basis. For auto sales, it's like 49% decline. Severe import restrictions to manage the balance of payments have been a major bottleneck here for the industries. Now, if we, out of the three sectors, the industrial sector, the agri, and the services, now let's move on to the agriculture sector. We have here is what we call a claim to fame, the agriculture sector. Yet we remain an underperformer in this critical segment of our economy too. The graph shows the production of two essential crops where production remains either stagnant or in a declining mode. That is despite our exponential population growth, which you can see the red line on your left-hand side. The population grew exponentially, whereas the production of wheat remained stagnant while the cotton production decline is on the declining trend. Considering the appalling situation in wheat, for instance, recently the government is claiming that we have a bumper wheat crop of 27.5 million. If it were not for the favorable climate conditions, we could have fallen behind our production estimates here too during this year. As you can see the graph on the right hand side, the cotton arrival have already slowed down and is expected to remain at around 5 million bales for the year compared to like 8.3 million bales the last year. The local cotton makes up almost half of the industry's cotton input. Now, this would have an adverse spillover effect on the domestic textile sector. If we look at the yields of the both of these crops, the wheat and the cotton, the productivity again is like stagnated, pertaining to the same two vital crops. The crop yields have hardly shown any pickup, which calls for the use of technology, highest quality seeds, or smart application of fertilizers, among other proven advanced techniques, which we are not following at all. Now, having discussed the real sector now, predominantly the industrial and the agricultural sector, let's now review the economy from the lens of the external and the fiscal accounts. I just want you guys to have a quick look at both of these sides of our external account, the current and the fiscal account first. So as we have discussed earlier, the balance of payment. So here we are. The external account or the balance of payment. It presents a difference in the total value between payments into and out of the country over a certain period of time. The two major subhead here are the current account and the corresponding financial account. The one on the left hand side and the one which you can see on the right hand side of the screen. The former records the value of exports and imports and of both goods and services and international transfers of capital, while the financial account majorly comprises the current country's net foreign investments and net external borrowings. Now, if you can see on the right hand side, the negative financial account balance, which I have circled in red, this is striking for this year, as you could see in the graph. While there has been a significant drop in the current account deficit so far during the year, courtesy to the import restrictions, the financial account, which have always remained a savior, instead posted a deficit for almost 20 years. Now, during this fiscal year, we have made a net repayments of around $2 billion instead of being able to continue to build up our stock of foreign debt, as has always been the case in Pakistan. Now, what's the negative balance on the financial account is telling us? How is that for a reality check? So the what effect it is creating the deficit on the financial account and the deficit on the current account is that reason why the noticeable improvement in the current account did not have any favorable impact on the FX reserves, which reflects the change in the balance of payment over the period. Because this time around, the current account and and the corresponding financial accounts, so you cannot see any significant increase in the FX reserves, and hence the rupee kept on a losing streak. Also note that in these unparalleled times, the value of the rupee is not dictated by the closely followed real effective exchange rate, the REAR, which is often quoted in the news blogs, or the purchasing power parity, be it relative or absolute, but by the tumultuous forces of supply and demand for the USD. Now, moving on to the fiscal account. So, what is actually the fiscal account? Or let me make it a bit simple. It simply reflects the amount of money that the government receives from its tax revenues and the proceeds of the assets sold minus the government spending. Now the slide shows our fiscal deficit and our expenditures breakdown. The fiscal deficit on the left hand side and the expenditure breakup on our right hand side. It is important to note here the expenditure component, the markup payment amounts for like 38.4%. Now, this is where the interconnection with other variables in the economy matters the most. Now, the tighter monetary policy, that is a higher interest rate environment, is having a major blow to the financial account in the shape of unprecedentedly high interest rates. Keeping in mind that 88% of this borrowing is originating from the domestic financing sources, as the foreign financial sources have dried up for Pakistan. The situation is so alarming that this year these interest payments are projected to even exceed the net federal receipt. The net federal receipt for the year is projected at around 5 trillion, whereas the interest payments are projected at around 5.2 trillion. If you see the line on the left hand side, it is showing the markup payment as a percentage of net federal receipts. So you can see that the line exceeds the 100% marks. So overall, the markup payments, they are now above the net federal receipt. So what does it imply? It simply implies that all other expenditures are to be met through borrowings. Unless and until any progress is achieved on the IMF program, the onus will remain on the domestic funding sources, which in turn would continue to crowd out the private sector borrowing. Now, this has led us to the hottest topic of these days. Now, the fiscal deficit and the current and the external account deficits. Now, The impact of these is the debt burden which we are carrying on our shoulders. I would like you guys to have a quick look at the slide and then I'll continue. It's the overall picture of the Pakistan debt burden. The bottom line is that our debt levels are increasing rapidly. Now, what is really sustainable level depends on each country's debt repayment capacity, which is essentially a function of external and the fiscal account. Our total public debt as a percentage of GDP presently stands at around 63%, which is not alarmingly high as compared to other comparable economies. However, what makes it unsustainable is our low debt repayment capacity. Nevertheless, the present much higher interest rate pose a serious risk here, particularly in the absence of external funding sources. As I have already alluded earlier, it will increase the interest payments further. As per the latest IMF estimates in FY24, from 5.2 trillion, the markup payments would increase to around 8.5 trillion in FY24. Note that the cumulative 75 billion is due in repayments from here to December 2025. One thing which I would like to highlight here on the left hand side of the total public debt, which is like around 232.8 billion, domestic debt here like is being shown as USD 146.2 billion. That is 63% of the total public debt. However, I have shown this here in the USD term. However, the domestic debt is denominated in PKR terms. Just for the comparison, I've shown here in the USD term, but not to confuse yourselves with, it is actually in the PKR denominated. Our total external debt is now stands at 86.6 billion, out of which cumulatively around 75 billion is due in repayments from here to December 25, 4.4 billion till June end as per the latest guidelines from the SBP post MPC meeting, and USD 15 billion till December end. If you can see the part on the right hand side, we have 15 billion total repayments due till December 31st. If we minus the 7 billions expected rollover from it, we need to pay around 8 billion till the end of December 23. So what does it imply? Quite simply, honoring all these payments won't be possible without IMF. Therefore, the program has to be extended beyond 2023 and with a larger deal ticket. This would also pave way for a possible debt restructuring. Yet, even in a best case scenario, there will be a negligible buildup in FX reserves, keeping the PKR highly vulnerable to external shocks. As I have already alluded to earlier, that PKR is not at all related in the current unprecedented circumstances. The rear or the purchasing power parity is not actually the governing factor for the exchange rate. It's the availability of the external financial resources that will govern the PKR US. Inflation is expected to remain entrenched on the back of the reforms implemented under the IMF program, which include adjustments in the utility prices, imposition of GST on petroleum products, and the market determined exchange rate. And even more excruciating is the forecast for the next fiscal year. Moving on, I would like to take a pause and seek your attention towards another variable before I delve into my discussion regarding interest rates and the yield curve, following which I look forward to my conclusion slide. Currency in circulation. So the graph in front of you is now shows the currency in circulation. That is the money lying outside the banking system, such as money in your wallet or on your couch cushions. Now that's rising every year. If you look at it in comparison to the banking deposits, if this money were to be deposited into the bank, the same could be put to effective use. The rising trend in the currency in circulation restrict the availability of loanable funds for investment by limiting the credit creation, which is crucial for the economic growth. Besides, this also signals the inflationary pressures because of the undocumented economy. Net wrapping up my discussion, it is clear that a contractionary policy is a central theme on the fiscal side, quite simply implying that expenditures should be cut and the revenue should be increased. And beware, this tone is supposed to gather much more steam in the upcoming budget. Having said that, the monetary policy will also remain tightly linked with the external account. On the other hand, the weight of any FX burden from the delays in inflow could be carried squarely on the MPC shoulders. Sadly, inflation remains a monetary phenomenon in our part of the world. Whole dilemma is already built into the inverted yield curve, as you can see on the left-hand side. The yield curve remains heavily front-loaded. The topmost curve, the one in the gray, is the yield curve depiction on the 30th April 2023. You can see the inversion in the yield curve. That concludes my presentation. However, before I close my talk, Let's spot the silver lining. So what we need to do right now, everybody, like all of us knows that we need to have enforce the reforms, and the continued efforts towards the fiscal consolidation and the policy reforms will be the key to the improvement in the macroeconomic recovery and stability. But the problem is nobody talks about how these reforms will be met. So when we talk about the reforms, what we actually means is the meritocracy and education. About the reforms, what we actually means is the meritocracy and education. For that, we need to invest in the human capital. And for in the absence of meritocracy, our institutions will remain weak. As in the case, as we have already witnessed in the case of State Bank, like the finance with any rapid change in the finance minister, when the finance ministers change, the almost the policies of State Bank drastically changes. So for that, we need to set our priorities right. We need to focus on exports for which we do not need imports. One thing that comes to my mind while considering any such thing is the agriculture industry, where we have a competitive advantage. The industry must undergo a transformative shift in its business approach, transitioning from a reliance on the imported goods to a focus on export, from the government directed structures of the agriculture to one driven by the private sector, from a rigid framework to one that promotes entrepreneurship, and from traditional practices to cutting edge technologies. Further, on the taxation system, we need to broaden our tax base. Currently, the tax collection as a percentage of GDP is around 4.8%. We need to get it increased to at least 8%, 6 to 8% in the short term, and above 10% in long term. We cannot continue taxing the already taxed person. We should be broadening our tax base. Next is the ease of doing business. What we need in these unprecedented circumstances is the FDI. And for FDI, we need to have an ease of doing business. The business environment, the administration, and the legal framework should encourage investment into the Pakistan rather than going out of the Pakistan. The Recordic cases and all other cases like Iraq and Iran gas pipeline, we have all of them in front of us, where we ended up having an arbitration thing out of the court and then lose the FX reserves of our country. So how all of this can be achieved? First and the foremost thing is the political consensus. Without political, across the board, anybody, like all the stakeholders must sit together. Otherwise, all the efforts will be futile. And finally, execution must come with the clarity of goals. We should remember that there are no short-term solution for the long-term challenges. And likewise, any short-term goal needs to be clearly defined and require effective priority setting. To close, as I've already alluded earlier, we are one of the most resilient nation. We can certainly come out of this crisis if we set our direction right and focus on the executions. Further, for the local investors, or as we have already discussed, the inflation is like skyrocketing. 35%, 30% average inflation, 35, 36, where SPI is going like 45%. And the income has not increased by that portion. We should stop the extravagant spending. Like on every event, when I look at my surroundings, on every event, being it a wedding or anything, we like to spend a lot. On the saving side, the major chunk of our funds are parked in either the current account or in the form of cash in our houses. So what is actually happening is the wealth is being eroded. As an investment advice for a risk averse investors, one should consider investing in a money market funds. For instance, you can invest in a JS money market fund or any other money market fund, which will at minimum return the policy rate. And for those investors which have like a higher risk appetite, the high net worth individuals, a staggered approach to invest in the equities is recommended. Thank you all. Thank you everyone. Have a great day. Bye.
JS Investments, managing mutual funds better.